Good evening, everybody. So I'm not going to take much time with the introductions because we are going to have Nilesh Shah with us, for a short while. He needs to leave for a regulatory meeting. So let's get into it very fast. Mr. Nilesh Shah needs no introduction. He is the managing director of Kotak Mutual Fund, Kotak Asset Management Company. And I have with me Mr. Shyam Shekhar, founder, I Thought Advisory. So I'm basically with two people who come with decades of experience in the stock market, in the capital market. So let's dive right in and get to know what India has to do to develop its capital market further. Hello, Nilesha.
Hi, Vidya. Very good evening to you.
Thanks for joining. So let's dive into the question, Nilesha. 10 years, I'm just taking a reference point of 2013 to 2023. 10 years and exactly a decade ago, India was not in such a comfortable position, as you will recall, whether it's inflation or the rupee depreciation, the rupee slide by over 20%. Our CAD was bad. Our forex reserve was depressing. And here we are now very comfortably placed. Our inflation is half of what it was then. Our forex reserves have more than doubled. Our own inflows, FPI inflows have more than tripled. Our domestic inflows have almost become 12 times since then. So when you look at this, what do you think? I look at this whole scenario as a kind of a top-down and bottom-up approach. So what has led to this growth? Has it been the large companies being comfortably funded and the growth happening through these large corporates, and India generally benefiting from these companies? Because obviously there is a ripple effect that happens when large companies grow. Or is it at the grassroots level, our small and medium and micro enterprises which increased, which grew and contributed to the growth of India? So which part was well funded? How does India as an economy grow by funding which part of this market cap segment?
So, Vidya, if we look at India growth story, do remember that whatever one says about India, opposite is also true. We are not a homogeneous country. We are a continent having multiple different kind of countries. One state, UP, is as big as Brazil. Other state, Goa, is as small as Estonia. One state, Delhi, will have per capita GDP of Indonesia, and Bihar has per capita GDP of sub-Saharan Africa. So whatever you say about India, it will only cover one way of looking at India, not the entire way of looking at India. Now, the growth of India on a top-down basis is driven by three things. One, there is talent retention. Throughout 50s to 90s, our talent was going abroad for better opportunities. Today, a major part of that is staying back in India. They are becoming entrepreneurs, they are becoming managers, and they are creating growth. The second is availability of capital. Earlier, your parents were funding your business opportunity. Today, there is a robust private equity venture capital ecosystem which has funded more than 90,000 startups with $140 billion in last decade. And this talent and capital is also supported by infrastructure. The infrastructure which we had in 2013, almost similar level of infrastructure is being built between 14 to 24. Roads, ports, power, airport, telecom, data, everywhere we have doubled our infrastructure almost. Now you create combination of talent, capital, and infrastructure, growth is inevitable. We also have to remember that our growth is looking better in a world which itself is not growing as fast. most emerging markets and developed markets are witnessing subdued growth, and which is why we are looking even better than what we might actually are. So growth is function of many things, government as well as private sector, large as well as small and medium enterprises. But in totality, I think it's combo of talent, entrepreneur and managerial, availability of capital in public as well as private market, and a rapid infrastructure creation, which combined has created growth opportunity for India.
Sham, what would be your views on this?
I think that if you look at the kind of opportunities that we need to create for our people, you need to encourage all kinds of entrepreneurs. India is an undercapitalized country, a country where capital for business is less, starting from the guy who does three, ironing, to the biggest Ambanis and Adanis. Everybody is short of capital in our country. So it is our duty to fund at all levels, and it is not going to work funding at one level. That is why we have these Mudra schemes and so many other things. And if you look at what has happened in the last decade, the financialization of India, which is through the JAM Trinity, and then so many other things that we have already brought into play sequentially, today it is possible for financial institutions, banks, NBFCs, microfinance companies to instantly understand the creditworthiness of every individual citizen of the country. Now, with this kind of an infrastructure, it is possible to give a loan within 5 or 10 minutes. That is why you have the speed of disbursal of loans accelerating. And I would think that this should continue to reach more people. More people should become aware of what we have created so that they access credit at the right place and use this capital entrepreneurially. So I think that the availability of capital is not an issue anymore. Access has been democratized far more in recent years than we have had in the previous 5 or 6 decades. And I would presume that this democratization and access of capital to all levels of people should definitely only accelerate further. So I would think that it is for everybody, and it is not for any particular section of society, be it the large corporate or just for somebody at the bottom. I think that at all levels, this is going to be available for us to use.
And the proof that there is availability of such the tremendous growth that we have seen in microfinance institutions and non-banking finance companies, their pace, especially post-COVID, has been in very high double digits in terms of, the credit lent and also their own profitability. So, and even much as we might think that there isn't credit, if you take a credit deployment report by Reserve Bank on the amount that banks lend to small and microfinance institutions, it's 16%. 16% is not a small number because these are not large loans, right? These are small ticket loans, but there is a certain proportion that goes to SMEs, to priority sector, to SMEs and all that. And the money, it is ensured that there is grassroots level funding at the bank level, NBFCs, microfinance institutions. So I would tend to think that there is a both top-down and a bottom-up approach that India is taking at this point in time, and perhaps a very healthy approach. The proof will lie in the pudding and how we see ourselves in the next 10 years' time, in terms of growth. So, but, I'll move on to the next more interesting question. So the first question I spoke about was a more broader funding for India. Now I'm moving to a very key, source of funding, which is, the capital market, the listed market money that comes both from foreign investors and domestic investors. So on that count, Nilesh, I have this question, having been in this industry for so long. We all know earlier how volatile the stock market used to be, and the kind of, inflows and outflows that we saw from foreign institutions. Now our market has become much more stable thanks to the domestic inflow that has been happening, both from mutual funds and insurance companies. We have been hitting new highs in the, we have seen new highs in the assets of mutual fund industry and, the retail money coming through SIPs. The question is whether this is sustainable, whether this will be gainfully used to grow the capital markets in the country.
So Vidya, you are asking a barber whether there is a need for a haircut or not. I have been beneficiary of mutual fund and my views are likely to be biased. But discounting my interest, selfish interest, I will still make a statement that this time domestic participation via mutual fund in equity market is on sustainable basis. SIP is now no longer a lexicon for the rich or urban India. It is as much, a father telling a daughter when she's starting her journey that beta ek SIP kar lena. Second, there is a huge amount of maturity today, which I am seeing among investors. There was a time when whenever market used to correct, I'm sure you and Shyam also would have received such queries that ab kya hoga, what will happen? And we used to, kind of tell people that don't worry, long-term story is good, and so on and so forth. Last 2 days, there has been a small correction. I can't even call it a correction. It's such a small drop. And yet investors are calling us saying that we want to invest money. So there is a maturity. Now, obviously, there are exceptions to the rule. So there will be some inexperienced people. But by and large, retail investors have become matured. There is a huge segment of mutual fund distributors who are handholding customers. There are set of customers who have positive experience of equity market, and put together, I will put my money that bearing few exceptions, this is likely to sustain. Our markets will become deeper with participation of both domestic and global investors, and there will be matured behavior by investors.
Different, question from this to Shyam. Nilesh, of course, thinks this is very sustainable. So we are seeing channelization of retail savings into the market, right? Now, this channelization in the past decade has been partly driven by the fact that real estate was not doing well. It has just seen a pickup. And, gold has become a lot more volatile ever since, the inflows of global ETFs, etc. So people have found kind of a respite possibly in this source. Or is it something else that is driving this flow?
I just start by asking a question. How many of you have made an investment in a financial product? Even if it's 500 rupees. How many of you have done a transaction in the stock market? Quite a few of you.
Does the product include cryptos?
I doubt that. Anyway, the point I want to make today is, if I tell you that in the next decade or a little longer, all of you should be owning financial assets worth at least 1 crore of rupees. How many of you have thought about this? That is the reality that we are now moving toward. And if you have this financial strength in your hand in the form of financial assets, that is the only thing that will make you buy a house on better terms. Otherwise, you're likely to be indebted for a longer part of your working career, which is not a good thing. So you compound, create capital, and then invest that capital, then your indebtedness will be for a shorter duration of time. I think that a lot of young people don't want to be indebted today, and that reflects in their willingness to invest. The second thing that I see is that with the way we are handling inflation as a nation, maturing over the years, I would think that investors would need to take risks, because otherwise their returns from debt would be suboptimal. It would not be like what it used to be in the years, because whenever you had the economy and the macros not doing well, debt investment started giving you higher returns. I don't think we are going to return back to that era in the near future. So given that, you need to take risk, and that is not something that you can shun. But the good news is that we have an economy which for 3 decades has chugged along at least 6%. And in that economy, we are seeing the country formalize more and more. Corporate growth has been at least between 10 and 12% at the aggregate level, which means that the profit growth of corporates can be at least between 12 and 15% over the long run, which means that if you buy stocks or mutual funds at a time when the valuations are reasonable, you are likely to make returns which mirror at least the lower end of the corporate profit growth, which is around 12%, or let's say 10, 12%. So this opportunity is before all of us. And it is only now, post-COVID, that investors have woken up to this. And you've seen the SIP books of mutual funds rising to 17,500 crores. Today, we feel delighted that this is a big number. We should see this number grow much higher, because you have barely about 2 crore people who have actually come into the system in the recent years. And that itself has contributed to, our assets going to as high as 50 lakh crores in the Indian mutual fund industry. And this is a very small sum. I think that India is now having a very, very sweet spot in the investment world, for the simple reason that so many of us are still yet to get in. So many of us are still yet to test our waters, or make some investment and start investing. Most people are still giving money to the banks to do their business. I think that most people will move towards making their money work for themselves rather than just give the money to the bank, which is why today you see the bank struggling to raise deposits. I think that that is also a reflection of a paradigm shift in the minds of the younger generation, and also in the minds of people who already have bought homes. Now they don't want to buy one more home or the second or the third home. They think that they should be financially stronger. And this wave of financialization is something that's here to stay for a very, very long time to come.
So mouse money is in, I guess. So no more, carrying on of physical assets, etc. for the present generation. So that helps. The other, point that over the past decade that I've noticed that may have brought in significant, savings into this, channel would be digitization, right? 10 years ago, you cannot think of doing a KYC with ease. You cannot think of, opening an account with a, for a demat or a broker account, or investing in mutual funds with fully digitally, right? Now that has become so easy for most of you. I mean, you can open an account in an app, you can, kind of start investing, etc. I think that is a big game changer. So innovation in terms of, digital technology has definitely played a large role in terms of channelizing the savings into, the domestic capital markets. Having said that, when I speak about innovation, Nilesh, we do know there's a lot of innovation happening in the fintech space and financial products, etc. But we also see the regulators, whether it is the SEBI or the RBI, frowning upon many of these innovations. Some of it very legitimate, because history has taught us this. Many of it doesn't go the right way. But nevertheless, are we less open to this kind of innovation than the rest of the world? And do you think some amount of an open mind here will help our capital markets grow better?
So, Vidya, it's all about our mindset as Indians. Are we willing to accept failure? When I think as a society, we want only success. We don't accept failure. If Sachin Tendulkar doesn't score a run in a match, I mean, there will be 20 people on street telling Sachin how to play, not accepting the fact that even God can fail once in a while. So that mindset which prevails in our society is prevalent everywhere. Today, there are more than 2 crore Indians who have lost money in Ponzi schemes, from PSCL to you name it, and people are losing money. But there is no regulatory intervention which is adequate, sufficient, and proactive to stop that. In the name of innovation, 10 crore Indians, are playing games like Rummy, Ludo, poker. There are 18 crore Indians who have traded in crypto. So we do want innovation, but innovation with guardrail. You can't have a bowling game without guardrails. And we have to balance between innovation as well as the guardrails which are necessary to protect investor interest. Unfortunately, in our judicial system, economic crimes don't get as much attention as, let's say, other crimes. Now that creates a very, very imbalance where honest people are burdened with compliance and crooks are willing to break laws because they are not afraid of punishment. So that's one thing which regulator has to take care, which is why they become more cautious. But at the end of the day, is there any debate about innovation? Answer is absolutely no. We need innovation. We need new products. We need new channels. We need new ways of spreading financialization. Just to give you a very small example, as Indians, how much gold we own, no one knows. In 21 years of this century, we have imported on a net basis $373 billion of gold. Export about 300 tons of gold jewelry a year, but import 1,000 tons of gold. Net 700 tons of gold come into India. We also know there is rampant gold smuggling based on all the gold seized at various customs. We also know there is, gold coming through Green Channel where people go like a normal human being and they came back like Bapilari loaded with gold. Collectively, would we have spent $500 billion in just 21 years for import of gold? Quite likely. Imagine if that money was invested in mutual funds, insurance business, bank deposits, or something else. What kind of growth we would have created? What kind of GDP we would have? Now, why are we not able to break this centuries old tradition? It requires innovation. It requires out-of-box thinking. It requires new way of marketing financial product. So there is a dying need for innovation. But before that happens, we need to ensure that there is an efficient judicial system which can punish wrongdoing, and as a society build failure. Innovation, there will be some success and many failures. As Thomas Edison famously mentioned, I haven't failed 100 times. I have found out 100 ways of not doing something. So if as a society we can accept failure, then I think our job will be done.
Great.
Vidya, my apologies, but I'll have to now leave.
Yes.
Our next meeting is likely to begin.
Yes.
So I'm so sorry, but you know my condition.
Thanks for joining us, Nilesh, in your tight schedule. Thanks.
Thank you.
So we spoke about innovation there. Shyam, so over maybe the past decade, what do you think, you could talk about one innovation or more than that, that has really changed the way capital markets work in India?
I think the most important thing is how fast we are able to settle transactions. A simple thing as this. In good old days, if you deposited a check which you received from someone, let's say in Bombay, it would take you days together and you have to go back to your bank to check if the money has been credited. Today, you don't have that, right?
Absolutely.
Similarly, if you made an investment in a stock, let's say you bought a stock, for you to receive the shares in your account or to physically receive the share certificates would take weeks. Today, you receive it the next day. Let's say you sell shares. For you to receive the money in your account would take weeks. Now you receive money the next day. Come April, it's going to become even faster. If you want, you can receive the money the same day. So there is so much of speed. Then, let's say you applied in a IPO. It would take 30 to 45 days for you to get the money back in your account. So the money would go to the company, and then the company would have to return it back through the transfer agents, and then there would be an agency to transfer the money. Today, the money doesn't leave your bank account.
It's blocked. Yeah.
It's only blocked in your bank account by a mechanism called ASBA. And if the company is allotting shares, the company can intimate your bank and then take the money. So the rest of the money is freed up the next day. This cycle, which used to be 45 days, has been now shrunk to 7 days. I'm talking the time between your application and then the listing of the shares. And the actual allotment period is only 4 days. So we have actually created a system which works seamlessly and efficiently and in a way in which it protects the investor and the capital of the investor. It creates so much of efficiency and safety. And I could say so many things are there today in the system which protect you. For example, share certificates. Today, if you go and check the website of a government entity called the IEPF, Investor Education and Protection Fund, there are shares worth probably lakhs of crores of people which have been lost because they lost the certificates. Or let's say your grandfather would have bought some shares and he would not have told your parents and they wouldn't even know. And after his passing, for some reason, they wouldn't trace the share certificate. These have been lost. Yeah. Today, there is no question of you losing any asset because it's all in the dematerialized form. So all these things have changed the whole ecosystem to a more investor-friendly way, a more efficient way, a way in which capital is traveling faster, which means that you are automatically going to get security and efficiency. And all this is only going to get better with time, which means that more and more people will become comfortable. And that is why you have crores of people today exercising an option, making a choice between whether they should give that money in their bank to the bank as a deposit or instantly click and make a mutual fund investment or go and buy a sovereign gold bond from the government whenever the issues are open or even buy a government security. Even today, how many of you know of a purchase of a government security made by you or by your family or friends? How many of you know? Very few. That's the point. Government security has the highest safety in our country. And despite being a highly financialized country, we are yet to see the spread of the culture of investing in government securities. Whereas in America, everybody owns treasury bills, right? We are yet to see that happen. So we still have some parts where we are ahead and some parts where we need to get ahead. But overall, the system is getting more and more efficient and it is becoming more and more investor-centric and investor-friendly. And technology and digitization is giving people a better sense of control and a better sense of security.
Right. So when Shyam mentions about being investor-centric, I think one of the biggest breakthroughs over the past decade that SEBI has been consistently working on is reducing the cost of investing and holding. Right? SEBI has been constantly pushing, whether it comes to your transaction costs or whether it comes to your paying commission for the brokers and distributors. This has steadily seen a fall. So the cost for you to invest is almost next to nothing. I mean, it has, for example, if you take passive products, index funds or ETFs, your cost is almost nothing. So the entire returns that you get to enjoy, right? So this is the kind of innovation. I'm talking of changes in innovation that have happened, which can channelize money into the capital market. Right. Speaking of capital market is not just about, the share market, the stocks, right? It is equally about the debt market. And while we cannot boast of a well-entrenched debt market, we have good news coming in. Good news that has come in because, there has been inclusion of India's government bonds in the JP Morgan index come June 2024. It will be included with a weight that will go up to 10%, steadily 1% a month, up to 10%. To us, for those of us in the markets, we do view this as a kind of a watershed moment for the debt market, because Indian debt market has never received, I mean, over this past decade, I spoke of the, trebling of, foreign inflows into the equity market, FPI. But the same FPI inflows into the debt market is just, kind of little over one times. I mean, it's just about grown. So we think this is a watershed moment, but do you think that this will also change the cost of borrowing overall in the country? Because end of the day, funding is what is needed for the growth of the country. So how is this going to help, change the cost?
I think that if you are only going to depend on debt flows from outside India, then that would be a bit risky. So while we are getting this inclusion into the MSCI index or whatever index that we want to get into with the debt market indices, wherever in, we should definitely also deepen and widen the domestic debt market. I think we need to create massive participation of Indian investors in the domestic debt market. Today, what is happening is you are just giving the bank money. You should have the corporation coming directly to you and borrowing from you. And the corporation should maintain the rating that they need to maintain so that they get a favorable rate from you. That would mean that the investor would be able to get a better rate of return by directly lending to the corporate, right? In the digital era, you don't have to worry about the cost of servicing this capital. Earlier, the thing was, if you do a debenture issue, then you need to have so many things in place and the cost of servicing, you need to have a very large RTS activity and all those things. Today, it's all digitized. So I think that today the cost of actually servicing a debt instrument is lower for companies than it was, let's say, a decade ago. But the domestic debt market has to be broadened and deepened. It's very nice to see that global debt is going to come to us, but that's a double-edged sword always, because if the country's macros are not managed efficiently on a continuous basis, and if you see a 2012 type of situation where the macros are not impressing the global investors and they lose faith, then it could be very, very difficult situation for the country. So we can't completely rely on overseas investments in debt. I think we should balance it much the same way as we have balanced the interests between the foreign portfolio investor and the domestic institutional investors. We have grown the domestic institutional market significantly in the last decade or two, and the foreign portfolio investors have been playing the counterparty mostly. So like that, we need to develop the debt market also in such a way that we have enough depth so that we don't expose ourselves to some kind of an event risk.
Right. So one of the things I think this inclusion of India bonds in the JP Morgan, one of the things that it can do possibly is release the funds that otherwise go into the G6 by compulsion. For example, banks have to necessarily hold a certain amount of SLR, statutory liquidity ratio, and insurance companies, they're all indirectly forced, your giant LIC, they're all forced to hold the government money because the government needs money. So the government issues bonds and it's telling folks here, hey, hold my bond, take my bond and give me money. So if the government is going to seek with these government securities, it's going to seek money from foreign portfolios, there's a potential release of money available locally to go into the corporate bond market, right? So you could possibly see, it will take a few years for it to play out. You could possibly see indirect effect by way of money flowing into the corporate bond market. Even today, actually, the corporate bond market has been steadily developing. A decade ago, we did not have these kind of bond platforms coming out there issuing, bonds that get listed. They may be risky. That's a very different, story altogether. But the fact is they are now available. One, they are able to come to a platform and to take money. And two, there are investors being able to easily service this market. So that to me could be the potential, advantage of India being included in the JP Morgan index, in this year. So with that, I'll have probably one more question for you because it's never without, a question on India's capital market growth story that we can end any discussion. So India, Shyam, has been steadily lowering its correlation with the global stock markets. It has been shown far more resilience We have seen even with the emerging markets, its correlation has come down. With EM, it's around 0.4 now, so it's significantly come down. Nevertheless, still, since foreign portfolio investment is a large part still of the overall market, we cannot be immune to the global turbulence and volatility. We are having, the talk of the fear of the US recession still going on, and the inflation in much part of the world, geopolitical tension, newer wars coming up, etc. So this inflow is vital for our growth, whether we like it or not. So how immune can we be, and will the India's own internal growth story still stay resilient? Help protect this capital market even if those global volatility, sets in.
The last 2 years would make you believe that India can do with FII selling, foreign portfolio institution selling. But the truth is that we will always be vulnerable beyond a point. So as long as the country's macros are giving comfort to the foreign portfolio investors and we continue to chug along at the same rate of growth, you will see these waves of selling and buying. They'll sell for a few months, then they'll buy for a few months, then again they'll sell for a few months. They have a much more dynamic approach to investments. But on the other side, the domestic investor seems to be very steadfast. And in a way, I think that domestic investors are little more aggressive than they need to be. And that is reflecting in the correlation, not being what you like it to be or being something that gives you discomfort. This is typical when so many people come into the equity cult for the first time. So they get a little carried away. They would definitely stretch themselves. It happens to all of us when we first come into the capital market, because you see some money, then you think that you're a wizard at investing, and then you overdo your investing, and then you will realize that you've gone too far, and then the market will moderate, everything will bring people back to the ground. That is bound to happen. And that will always continue to happen in every market cycle. So if you see the froth in the market today in specific parts of the market, I think it will have to come down. But if you ask me whether the whole market is in a state of froth, I think otherwise. If you look at the large cap universe, which captures most of the capital of the country, I think that maybe we are discounting one more year of earnings, which is very, very normal, which means that if the stock market stays at the same place also, then you're okay after 1 year. If it comes down 10%, then immediately you start becoming more comfortable with the valuation. If it drops 20%, then your comfort grows higher. So in the larger picture, we are not in a position where we need to worry so much about the structural stability of our market. But certainly, if you take parts of the market like the SME market or the small cap or the micro cap or the mid cap market, where a lot of retail money is, very heavily invested into, we could see a few shocks, right? It's bound to happen because in the stock market, any behavioral excess is certain to be punished. Whether you are the biggest investor in the country or somebody who puts 1,000 rupees, everybody gets punished. It's very democratic in that sense. So it is up to us to maintain the discipline as investors and decide where we stop and where we will set the limits of risks for ourselves. I think the covenant is always with the individual, and it's not something which you can hold a regulator or a government responsible, because they can only control to a point. How can they stop people from buying or selling stocks? So they can only do it to a point. Beyond that point, it is up to us to protect ourselves. So that is something that will always be there. Yes, there is a risk at this point in time, but we must be very cognizant of that. And our behavior should be accordingly moderated.
So there needs to be some fear than just greed is what Shyam is
It's always the
hinting at.
case. There are always two sides to this. You cannot just be greedy or just be fearful. You should have the right blend, and you should be fearful where you need to be fearful and greedy where you need to be greedy. So even in the same market, you can see a large company which is going through some, patch of rough, but you know the track record of the company and you know how good it is, you know the governance. Then what you apply on that company should be very different from what you apply, let's say, in a frothy part of the market. So you can actually take this money from the frothy side of the market and put it in the safety of the large company and let it rest there. So this is always there before us, but none of us want to leave the party and go to a safe place. So that is a behavioral thing for which we will, in the end, be accountable to ourselves. We cannot externalize our responsibility.
Yeah, so the beauty of the having financial products is each one of you, I mean, as an individual, you actually, so the topic here is about funding India's growth. Each one of you play a wonderful part in funding India's growth, which is why, this entire concept of capital market, especially from retail investor, takes a big shape in terms of India's growth dream. I'll just give you a simple, example. Let's say that you're buying, the stock with disclaimers that there are no recommendations here. Let's say you buy the stock or even the bond issued by Credit Access Grameen, which is a microfinance institution. You are big time funding the India growth dream, right? I mean, this money goes into funding, women's working group, which does, small businesses and earns. Right. Similarly, I mean, if you take any kind of sector that you want to participate in, investing really directly contributes to the growth of the economy. So that is where financial market, financial product assume importance. Right. You're contributing. I mean, you're working in an organization. The organization contributes to overall GDP of the economy. The GDP grows. That is one way of looking at it. But participating in that growth comes through these financial products. And that's what makes the capital market a very rich playing ground end of the day, and also reap the benefits for the country. With that, we'll be happy to take any questions for a few minutes. If any of you have, yes, please.
Hello, good evening, everyone. And I'd like to ask, my name is Anubhav. I'm from the Bloomberg Asian College Journalism course. What's your take on the current SME IPO rush in the Indian equities? Is it a bubble at this stage of the market? This is the equities question. And one question I have on debt market, which is companies like Vedanta existing corporate bonds. So in that scenario, will not FPIs and FIIs will be wary of the Indian markets because of companies defaulting on bonds?
Take the first question on SME IPO.
Yeah. See, quite clearly, the SME space is not a safe space today. I'll tell you, suppose somebody wants to raise 100 rupees for his business, 100 crore for his business. You're giving him 10,000 crores by way of subscription. What are people doing? They're trying to participate in that lottery. The entire SME IPO ecosystem today is working like a lottery, right? And please understand that the regulatory compliance requirements for a SME is much lighter than it is for a larger entity. So too many people are going into this lottery in the SME space to make a fast buck. It's like everybody is playing passing the hat, and you don't know who's going to hold the hat when the music stops. But everybody is doing this knowingly, right? The regulator is trying to caution people, trying to put in some hard measures. But I guess that you will see a lot of pain in this space. It is inevitable. The kind of behavioral trends we're seeing here clearly point that we would have a problem. That is my view.
On the debt question. So when we talk of FPIs coming in, a majority of the money goes into G6, government bonds. Okay. And even this inclusion in the bond, JP Morgan is the G6. So as long as your country is investment grade, I mean, you have your Standard and Poor, etc. rating, we may disagree with what they rate, but it's what they rate, right? We are investment grade, and not without that are we entering the index? There are other reasons why we have entered the index, the Russia-Ukraine war, Russia had to be removed and things like that. But this was due, right? So India is investment grade. A company like Vedanta, whether it has credit risk issues or any other, I mean, take the earlier, falls. We had a large IL&FS issue happening a few years ago.
I'm sorry to interrupt.
No problem, yeah.
let's go to the Adani issue,
Yeah.
because that's something which you are all very curious about. The Adani issue was a strike on the debt market exposure of that
Itself,
company. It was
yeah.
not a strike on the equity, because you could not really short those shares too much.
Absolutely.
It was a strike on the debt market side. That's why today Adani in panic has had to either refinance his debt or repay his debt, right? So the market has its own balance. You can't take the market for granted.
Yeah.
The debt market, you can't take it for granted. Even if you take Vedanta, the last time they refinanced was a walk in the park. This time, I don't think it has been easy for
Easy.
them. And they are forced to do a lot of things. Firstly, the interest rates are very high. And they are also forced to sell assets, take some hard decisions, and deleverage themselves quickly. It's not as if they can fix a few people and solve their problem. It doesn't work that. The market is much bigger than groups like these, and the groups will have to adapt. The same group was able to raise debt very easily a decade ago, and they went.
Absolutely.
Right? So it gives you a chance. It's entirely up to you to live up to the opportunity that the market gives you. And if you don't live up to it, however strong you may be perceived to be, the debt markets are very brutal. And
Yeah.
the Adani episode is a very good example for us that the markets have a very strong balancing power.
The yields spiked in Adani, but it's not like all our G6 went up equally, right? So the market knows, it knows. In fact, they say many equity investors, discerning investors look up to cues in the debt market. Debt markets are, they say, fast and
So
discerning.
I have a
So-
friend who bought the Vedanta bonds when the yields were running at 40% and sold it now. He's doubled his money, right? So there are risk takers at that level.
So that doesn't though impact what FPIs do with government bonds. So that was the point that I was trying to. They know the segments, and two, FPIs largely come only where there is liquidity. Liquidity in Indian market is there only with G6. The rest of the corporate bond, like he made the point, is not even the depth is very, very poor at this point in time.
Hello, my name is Khushi. I'm also from the Bloomberg Business Finance Journalism course. I may have enough questions for an interview, but I'll stick to one. Jeffrey's group recently said it in an interview that the market is expecting a higher capex in the upcoming budget, but the government may decrease the capex in order to increase its expenditure on subsidies, and that may upset the market. What are your views on that?
If we are talking about the interim budget, that is possible because it is only signaling, right? The interim budget will come on February 1st. It's only to manage expenditure till the new government takes over. I would think that the new government will hike the infra budget to 15 lakh crore from the current 12.5 lakh crore. I think it's a given. And I would think that every year this infra spend has to go by at least 2.5 lakh crore in the term of the next government, no matter who wins the election.
Yeah.
It is a necessity. Now, if we are going to reverse this direction like we did between 2004 and 2009, that would be disastrous for the country and you will meet the same results which you faced. See, when government spends, right, it gives confidence to others also to spend. It creates a ripple effect. And we are already behind China by about 3 or 4 decades in infra, right? We need to catch up. You cannot leave a decade like that to chance to the private sector. And in any case, let me tell you this, Indian private sector does not have the balance sheet to do these big things. They don't have the balance sheet. So you may think that, oh, India is in the hands of a few corporates and all that. But actually, these corporates are pygmies in relation to what we need for our country. Yes, we need a better set of entrepreneurs, risk takers who are accountable, but these guys are not sufficient for us. What we think in our mind is that we have too much of, let's say, an Ambani or an Adani or a Tata, but actually invert it on the head. If our country has to develop and more people have to get more economic opportunities, you probably need much better, bigger entrepreneurs who will create those opportunities. That's why you are having all these unicorns, and we are trying our hand at many things, knowing fully well that some of these will fail. But that whole experiment of encouraging more people to create enterprises faster is a reflection of our recognition that we need more entrepreneurs, right? In infrastructure, rest assured that you either create newer entrepreneurs or you create vehicles into which global capital can come in. Like the sovereign wealth of the entire Arab world will be interested in investing in India's infrastructure. The question is, should they invest in India's infrastructure through, let's say, an Adani, or through a government promoted entity, which is a REIT or InvIT, or different vehicles? I would think that we'll gravitate more towards the other side. So the government will free up some assets, sell some assets, free up capital, and invest aggressively in creating new infrastructure assets. I would not think that we can slow down or reduce, but cosmetically, optically, before the election, for political reasons, they may show that they're going to spend the same amount. They will not reduce, as they have done in the current financial year. That's the best case. I would be very surprised if they reduce. It's very easy for them to overestimate revenue in the interim budget and still show infrastructure spending. It's all optics. Don't take the February 1 budget seriously. Don't take it seriously. You'll have to wait for the real budget. And I would think in the real budget, if you don't have a regime change, the chances are that the infra spend will go up. If there is a regime change, then it depends upon the vision of the Prime Minister.
Just one small addition to that, then what is the market's expectation from this interim budget? Will it help some industries?
See, actually, budgets have stopped making a meaning to the capital market. It's just the TV channels, because it's an event for them to create advertising and all those things. They create all this hype, call people. It's a tamasha, yeah. But see, it's like, if you're going to receive your report card in ACJ, is it an event? Right? Budget is the report card of the government, where the government has to make an honest submission of what its financials are, what it has done based on what was the promise and what is the actual. If it has lived up to what it has promised or done better than that, then the markets or all of us in whatever capacity have a reason to cheer. If not, we should take an adverse view, right? Whereas we have a very filmy way of reacting to budgets. We like headline statements. We pick what we want to and we start getting excited. Budgets have very limited meaning or impact on the corporate world, except when you alter their taxes, which is the direct tax, which is already altered. It's already reduced. So there's hardly anything that the budget can do. When you say that I will invest more money in infrastructure, that gives a certain fillip. When you say that your fiscal deficit will be managed in a better way than you did the previous year, and you promise to make it better than what people expect of you, then, that gives a little bit more confidence. Budget is more a confidence building exercise and a time when you report. It's a report card moment. So I think that the capital market has made it kind of a ritual and a tamasha, right? I think I would blame the television media more for that than anybody else. And all the brokers, everybody, because they get more business, right? You go and try and do something, everybody makes money, so everybody is happy. But other than that, I don't think the budgets have great import.
Absolutely. In fact, there are significant changes. If you take, the Monetary Policy Committee, every few months they meet. So if you read those reports in detail, building of the entire India's financial system, etc., has been slowly carved from there, right? And there are multiple other committees that are formed. So it's not these budgets, it's things that happen right through the year, very key announcements, major changes, etc., all happen. I mean, forget budget. Look at the private equity and VC funding scenario in India, right? That has been thriving. Of course, it fell by almost 44%, in 2023. That's not a very good sign, but That's so globally too. But there are many other key events. In fact, taxation changes sometimes happen in between for these PE, VCs, etc. So none of these are budget related items. So I think there is enough news, enough juice for you people outside of the budget. If you keep watching these, regulatory notes elsewhere, whether it's with RBI, SEBI comes up with papers every week now. There is enough news out there. So those are major regulatory changes happening.
Also, you look at your calendar of events.
Yeah.
See, every month you get data. Every month you get data. There's a calendar. In fact, if somebody creates a financial event calendar, it's good business. Because there's so many things that happen on particular dates. Things keep coming out, and you have IIP data, then you have your business managers index, your confidence. So many data points are coming out continuously. Then you have the vehicle production, then you have the actual sales at the point of the dealers, and then you have the cement sales, then you have power. You got so much of data that comes in. So you should be more routine data driven than budget driven. I would think that that is more important for anyone who is interested in the financial world to focus upon.
In fact, what the budget doesn't touch upon, your transportation and logistics data, your automobile data, all of these are key early indicators for the economy's growth, So there's enough and more information available today outside of the budget.
You just look at the indirect tax. You see, when I was probably your age, we would see what is the tax collection only on the budget day. Right? Today, every month, the GST numbers are there state-wise. Every month, there's a disclosure. So you don't have to wait for the budget to decide whether the government is able to mobilize enough taxes. And the same applies to the direct taxes also. You have regular updates. Today, you see, on 1st of January, they give a report as to what is collected till 31st. Direct taxes, income tax. So you are really up to date most of the time. So the budget has lost its charm in all these things because you are already up to date with information right up to the previous month. So what you're going to get filled in is what the budget says is how much will happen in the rest of the year. It's just for that rest of those probably 1 and 2 months. That's what it says.
And there is anyway a revised estimate and one revised estimate and more revised estimates happening anyway in the budget. So yeah, sometimes loses relevance.
Hello, my name is Preeti. I'm also from the Business and Finance Journalism course. So the US recently allowed Bitcoin ETF to list and trade on its stock market. What does it mean for the Indian investor community?
So as far as Indians are concerned, unless it is you hold dollar money, okay, somewhere in the US or elsewhere, and you will be able to invest, it really doesn't make a direct, investing opportunity, doesn't give you a direct investing opportunity. India last year, or even the year before has come down heavily on, this activity, especially from a taxation perspective, because the government knows Indian investors are most sensitive to taxes, right? But what it does to those who hold other, coins, perhaps not Bitcoin, and please remember, everywhere in the world where ETFs are created, eventually, because price arbitrage goes down. If you take gold, the price arbitrage, etc., significantly comes down. The ability of that asset to, become more efficient happens when there is ETF built in. So even building of Bitcoins per se may not be a big positive for Bitcoins, but there are these hundreds of other coins out there which are still not traded, which don't have an ETF. These will go up, right? So if you're still stuck with many of these other coins, you might see an increase in the value of those coins. So to that extent, that is at an individual level, that's the impact. In India, I don't think we have taken any major decision. However, we have some fund of funds that can participate in these global ETFs. The scheme information document of these mutual funds, if they can be modified to include this class, then you will be able to participate. But whether SEBI will allow it, we'll have to wait and watch.
See, there is one problem with Bitcoin for Indians. Assume you make profit. Then you're taxed at the full rate. which is 40%, roughly 59%. Assume you made a loss, you cannot adjust it against your income, against any other head.
There is no
You
set
cannot-
off of
There's no
taxes.
set off. So when you have such a very strong, I would say even a draconian clause, there is a strong disincentive to invest in Bitcoin in India. Because most people lose in Bitcoin. So far, there are more losers than winners. I have not seen anyone who has really won.
Maybe people made money with NFTs here, some of them. We don't know. So, right. I have a whole bunch of teammates who have invested in cryptos, in NFTs. So, they give me eloquent classes on these. So I understand. But yeah, in India, regulatorily, nothing really. But like I said, in case this is possible through the mutual fund route, we already have a couple of mutual funds, who can participate. So we'll have to see whether this ETF route will, be added. Right,
Hello,
move.
here. I'm Avrup. I'm from the Integrated Multimedia Journalism course. So my question is that with how easy it has become for new investors to get into the IPOs through their application platforms online, so how would the new investors like safeguard against inflated IPOs, say with inflated subscriber numbers? And beyond the 2021 SEBI regulations, has there been any new updates that SEBI is planning to like do more crackdowns on these inflated IPOs?
See, I think that
Regulators.
they will probably look closer at the documents which are filed by these companies. I think the number of approvals may come down a bit. That is certain. It's very easy to invest. See, the whole thing is you made it so easy. You shortened the cycle time of an IPO. You put the money, fourth day your allotment is over. Seventh day the stock list. The cycle time has come down. It's supposed to make life simpler for people who are investors. But the outcome is actually the opposite because it has created more speculators instead of enabling investors. So more people are speculating in that. And that's why you have all these oversubscription and all that. I don't know how SEBI can stop this because you can't stop people from subscribing.
See, this is again a market risk. SEBI can only put in a broad framework for things to happen in an orderly way, but it cannot stop people from being too greedy.
See, there is something called a gray market, what they call as a gray market premium. Earlier, it used to take 45 days for a company to complete the public issue and list, right? So if you have a premium, it is that excitement between the day of opening of the issue and the day of listing. There was a 45-day cycle. Why do you have a gray market premium in a 7-day cycle? Yeah, there's hardly any time. But our society wants to speculate so much that old habit is not dying so fast. So the only way I would think this can actually be suppressed is by going for online IPOs where they say that this is my floor price. The company says. And the market can bid up and give the money to the company or the shareholders online. Right? Rather than follow this current system of lottery. So somebody can take that risk and overpay and expose himself to that risk. I think that should happen. In India, I believe that the other stakeholders in this whole exercise, which is the investment bankers, transfer agents, they are somehow blocking SEBI from making the entire IPOs exchange driven and online. The day we do that, I think this whole thing will get compressed. And I think that the only way in which what you are saying can be addressed by a regulator is through this matter of time before it happens.
Hello.
We have, we
I
have
have-
time for one last question. So please.
Yeah. So you both talked about how the financial market has increased for India. So we can talk about the financial awareness that has increased in India. The same has been talked about financial influencers, though, where SEBI is cracking down on financial influencers. What is your take on it? Are they providing any financial, are they part of the financial awareness created in India? What is your take?
Yeah, first.
I think financial influencers have made discussions in finance very exciting for viewers. That's something which they made a boring subject very exciting and very animated. But in the process, they have got investors into believing a lot of things which may not be in their long-term interest. And SEBI recognizes this, but I don't see how a financial regulator can control a YouTuber. It's very difficult. I mean, it's very, very difficult because that guy is going to put out content every day. And I'll tell you one more thing. I run a registered investment advisory firm and a portfolio management firm. You know the rule for me to put out a video? I have to send the content to BSC, which has a subsidiary, and that BASL, and that guy has to approve my video. Right? And it will take probably weeks, by which time my video would lose value. So today what has happened is all those whom SEBI has actually approved as legitimate advisors don't have a voice, while the influencers have a free run. Right? So it's a tyranny of this lot which is running in the country. And see, there's one thing that most people are yet to understand. I think you'll have to give it a bear market to understand this. Financial influencers are saying that the advisory industry in its various components are a vested interest. Okay, that's the broad narrative which is succeeding in our country today. It's like when I was young, when you see a film, a character in the film will say, that guy is rich, so he must be a bad guy. Right? So today the equivalent of that is, this guy is a financial intermediary, so he must be a bad guy, he is making money. Now, this is something which a lot of people like. So they like to believe that there would be an advice they will receive which comes without a cost. Influencers are basically today very effectively using this emotional need of a large section of our population to create their own vested interest, which is, don't go to the legitimate organized industry, come to me. I will sell you a course. I will give you tips. I will put you on a Telegram channel where I will tell you what to buy and what to sell. And please watch all my videos so that I get subscription and advertising revenue. So they are creating their own ecosystem and a financial model, which is not subjected to any scrutiny. So this is where we are. And it's a matter of time before we try to address this. But I still think we would not be able to effectively address this. I think you have to empower the formal advisory community far more and create a counterbalance rather than think of how you will suppress what the others are doing.
Yeah.
Because you have suppressed the formal regulated entities so much that they don't have a voice.
Actually, you guys should just go out and Google on the requirements. There's a proper SEBI regulation on this, on registered investment advisors or research analysts or PMS, what they need to comply before they can even market their products. It is a lot, right? Especially in the digital marketing space, where you put Google ads that change by the hour. You know, you're supposed to, like he said, go to a regulator, get it vetted, and then it comes back and you actually pay a fee to get it vetted every time, right? And then there are influencers. The problem is that, unfortunately, this concept and this entire crop of influencers have come since COVID 2020, largely. There have been a few before that, but a large crop. And people who haven't really seen the various phases of the market and how brutal the market can get, whether it is in equity or debt. So what people, viewers like about these influencers is the high positive message that they get, right? That investing is easy, you can make money easily. So this positive message basically is, obviously, you know, you get influenced, which is what their job is, very easily with it. And it doesn't stop with just starting these Telegram channels or YouTube. Where it has gotten toxic is collecting money. And that is where SEBI stepped in. Until that point, you know, SEBI was silent. They have started giving their bank accounts, make a UPI transfer. If you go and look at the papers that SEBI has, the judgments that it has passed, you will actually come across very, very, dubious ways in which this has been done, right? So our view, yes, I mean, as a financial community in the regulated entity, this has definitely brought in much more awareness. Just as mutual fund SEBI campaign has brought in a lot of awareness, financial influencers have brought in a lot of awareness, but unfortunately, they make the whole investing seem like the easiest of things. If wishes were horses, I don't need to finish it.